$1, 1 trillion, gone in 18 months. Not stolen, not sanctioned, deliberately dumped by China while every economist in Washington insisted it couldn't happen. The Federal Reserve watched, calculated the consequences, and did absolutely nothing to stop it. And here's what that means for your savings account, your mortgage rate, and every dollar you're holding right now. When the world's second largest economy decides American debt isn't worth holding anymore, the cost doesn't stay in Beijing. It lands in your wallet. Every percentage point the Fed has to raise rates to compensate for Chinese selling. That's your car loan getting more expensive, your credit card interest climbing higher, your home equity shrinking faster. This channel runs on no corporate funding, no government backing, and no advertising pressure telling us what to leave out. If this kind of analysis matters to you, the kind that connects Treasury auctions in Washington to the financial pressure building in your own bank account, hit subscribe and turn on notifications. Because what China just executed is not a one-time move. It's the opening sequence of a financial strategy that most Americans won't understand until it's already reshaped their economic reality. Let me show you exactly what happened. Between March 2022 and September 2023, China reduced its holdings of U.S. Treasury securities from $1, 3 trillion to roughly $820 billion. That's $480 billion in 18 months. To put that in context, China dumped more U.S. debt in a year and a half than the entire GDP of Belgium. The selling wasn't panicked. It wasn't erratic. It was methodical, steady, and perfectly timed to moments when the Treasury market could absorb the pressure without triggering immediate crisis. The official explanation from Western financial institutions: portfolio rebalancing, diversification strategy, normal central bank operations. Every major outlet ran some version of this narrative. Bloomberg called it unremarkable. The Wall Street Journal described it as routine adjustments. The Treasury Department itself issued statements emphasizing that foreign demand for U.S. debt remains robust and stable. The operational reality tells a different story. China didn't just sell treasuries. It sold them while simultaneously accumulating gold at the fastest pace in 4 decades. Beijing added more than 400 tons of gold to official reserves. During the same period, it was dumping dollars. That's not diversification. That's replacement. When you sell one asset and immediately buy another, you're not rebalancing, you're switching teams. Here's what makes this technically significant. U.S. Treasury securities are considered the safest asset on Earth. The entire global financial system is built on the assumption that American government debt is risk-free, liquid, and essential. Every major institution, banks, pension funds, insurance companies, sovereign wealth funds, holds treasuries as the foundation of their balance sheet. When the second largest foreign holders start systematically exiting that position, it sends a message louder than any diplomatic statement or trade negotiation. And here's what they're not telling you. The Federal Reserve knew this was coming. Internal Federal Reserve research papers from 2021, publicly available if you know where to look, explicitly discuss the risk of major foreign holders reducing Treasury exposure in response to U.S. sanctions policy. The Fed's economists modeled scenarios where China might reduce holdings by $500 billion over 2 years. Their conclusion? Such a move would add upward pressure on yields, forcing the Fed to maintain higher rates for longer to attract replacement buyers. That's exactly what happened. But when it actually started occurring, the official public messaging was no cause for concern. Now here's the part that changes the entire picture. China didn't sell into chaos. It sold into strength. Look at the timing. The bulk of Chinese Treasury sales occurred during periods when the U.S. economy was posting strong employment numbers, when inflation data was coming in hot, and when the Fed was already raising rates aggressively. From the outside, it looked like China was just riding market conditions. From the inside, if you understand strategic timing, it was perfect cover. Sell when everyone expects yields to rise anyway. Your selling pressure gets masked by the Fed's tightening cycle. No one can isolate your impact from Powell's policy. The strategic calculation Beijing made is visible in the data if you know what you're looking for. China reduced Treasury holdings while the U.S. was simultaneously imposing sanctions on Russia, freezing Russian central bank assets, and openly discussing similar measures as potential tools against other nations. Every Chinese economic planner watched those sanctions get deployed. Every Chinese central banker asked the same question. If geopolitical tension escalates over Taiwan, over the South China Sea, over any number of flashpoints, what stops Washington from freezing Chinese assets the same way it froze Russian assets? The answer: nothing stops it except not having those assets in American hands in the first place. Let me show you the math that explains why this move was not just smart but inevitable. The United States holds roughly 32 trillion in national debt. Foreign holders own about $7, 6 trillion of that total. China, at its peak, held $1, 3 trillion, roughly 17% of all foreign-held U.S. debt. That concentration created a mutual dependency that Beijing decided was unsustainable. Here's why the numbers forced their hand. Every dollar China held in treasuries was a dollar the U.S. could theoretically freeze in a crisis. $1, 3 trillion in potential leverage, except the leverage ran both ways. If the U.S. froze Chinese treasury holdings, it would trigger a global financial crisis. China understood this. But China also understood that once you freeze one country's central bank assets, you've proven the system is political, not neutral. That revelation changes every calculation for every other major holder. So what does China get for selling 480 billion in treasuries? First, reduced vulnerability. Second, 400 tons of gold that can't be frozen by Washington. Third, and this is the critical piece most analysis misses, proof of concept. Beijing just demonstrated that you can exit the dollar system gradually without triggering a currency crisis, without collapsing your own economy, and without giving the U.S. advance warning that allows them to prepare countermeasures. That's not just a financial move. That's a blueprint. The cost asymmetry is stark when you zoom out. China loses some yield, treasury returns versus gold returns. But China gains strategic autonomy. The U.S. loses a captive buyer for its debt. The Fed has to find replacement demand, which means either higher yields to attract new buyers or the Fed itself stepping in to buy more. Higher yields mean higher borrowing costs for the entire American economy. Every mortgage, every car loan, every corporate bond, every credit card, all priced off the baseline of treasury yields. China spent $480 billion to buy freedom from potential sanctions. The United States will spend trillions over the next decade in higher interest costs because that buyer is gone. Who got the better deal? The math answers itself. Now pull back from the immediate mechanics and look at the geopolitical chessboard. China's defense minister is not watching U.S. Treasury auctions because he cares about bond yields. He's watching because financial autonomy is a prerequisite for military autonomy. If Beijing decides to move on Taiwan, the first thing Washington will do is freeze assets. If those assets are already out of reach, already converted to gold, already cycled through yuan-denominated trade, already repositioned into non-dollar reserves, then that lever disappears. Russia learned this lesson the hard way in 2022. Roughly 300 billion in Russian central bank reserves frozen overnight. The Russian economy absorbed the shock, adapted faster than Western analysts predicted, and continued funding military operations through alternative channels. But the lesson for every other major power was clear. Dollar reserves are only yours until Washington decides they're not. China studied that moment. The timing of Chinese treasury sales accelerating after February 2022 is not coincidence. It's cause and effect. Beijing watched the Western financial system get weaponized in real time and concluded that exposure to that system was a strategic liability masquerading as an economic asset. Here's where it gets more dangerous for long-term U.S. interests. China is not alone in this calculation. Japan still holds more than $1 trillion in U.S. treasuries. Saudi Arabia and other Gulf states hold hundreds of billions. What happens when they watch China execute a successful de-dollarization blueprint? What happens when the next geopolitical crisis makes them question whether their treasury holdings are safe from politically motivated freezes? The answer is already happening in slow motion. Look at the data from the past 24 months. Foreign holdings of U.S. treasuries as a percentage of total debt have been declining gradually but consistently. It's not a collapse. It's a drift. Major holders are reducing exposure incrementally, enough to lower risk, but not enough to trigger panic. That's the smart play. That's what China just taught them how to do. Russia is watching quietly and with satisfaction. Every dollar of U.S. attention consumed by managing treasury demand in the absence of reliable Chinese buying is a dollar of attention not directed at countering Russian influence in Central Asia, in Africa, in the Middle East. Moscow didn't have to do anything to benefit from this shift. Beijing did the work. Russia gains passively. The message transmitting to governments across the developing world is not subtle. American primacy has real limits. A nation that invests in strategic commodity reserves, gold, oil, rare earths, can reduce dependence on dollar-denominated systems without suffering economic collapse. China just ran the experiment. The hypothesis was you can de-dollarize gradually if you do it smart. The conclusion hypothesis confirmed. And here's the dimension almost nobody in the Western financial press is discussing openly. What happens when yuan-denominated trade becomes the preferred option for countries that want to avoid dollar exposure? China is already offering this framework. Buy oil from Russia or Iran or Venezuela in yuan. Sell manufactured goods to China in yuan. Keep reserves in yuan or gold instead of dollars. The infrastructure for this alternative system already exists. What was missing was proof that major economies could transition without crisis. China just provided that proof. The dollar's role as global reserve currency was never guaranteed by law. It was guaranteed by convenience, by network effects, by the sheer scale of dollar-denominated trade. But convenience is not loyalty. When convenience becomes risk, when holding dollars means exposure to politically motivated asset freezes, the calculation changes. China changed it. Now the question is how many others follow. Let me show you what the Federal Reserve actually did in response to this pressure. Nothing visible. No emergency measures. No public statements acknowledging the problem. But look at the Fed's balance sheet. Look at the composition of assets the Fed itself holds. Over the same period China was selling treasuries, the Fed maintained elevated holdings of government securities purchased during quantitative easing. The technical term is passive runoff, letting bonds mature without replacing them. The practical reality is the Fed slowed that runoff significantly in 2023, specifically to absorb some of the gap left by Chinese selling. They didn't announce it as a response to China. They framed it as data-dependent policy, but the timing maps perfectly. Why couldn't the Fed stop China from selling? Because the only tools the Fed has are interest rates and asset purchases. Raising rates would have made treasuries more attractive, but it also would have pushed the U.S. economy toward recession faster. Buying more treasuries directly would have undermined the Fed's entire inflation-fighting strategy. China boxed the Fed into a position where every response option carried unacceptable costs. That's not luck. That's strategic planning. What burned through $1? $1 trillion in Chinese treasury holdings is not just portfolio adjustment. It's the beginning of a structural shift in how the global financial system allocates risk. It's the first major economy proving you can exit dollar dominance gradually, without triggering the apocalyptic scenarios Western economists have been predicting for decades. Here are my 3 predictions, with a clock attached. First, within 18 months, at least 2 other major foreign holders, my bet is on Saudi Arabia and one Southeast Asian nation, will quietly reduce treasury holdings by 15% or more while increasing gold reserves. Second, by the end of 2026, yuan-denominated trade between China and Russia will exceed $300 billion annually, creating a parallel financial system large enough that smaller nations can plug into it without depending on dollar clearing. Third, within 3 years, the Federal Reserve will face a choice: either accept structurally higher interest rates to attract replacement buyers for U.S. debt, or expand the balance sheet again and admit that quantitative easing is now permanent policy. Drop your prediction in the comments. Which happens first? Another major holder follows China's blueprint, the yuan trade bloc hits critical mass, or the Fed blinks and restarts large-scale asset purchases? Tell me, because I read every single one. If this gave you a framework for understanding why your interest rates are not coming down as fast as the headlines promised, if this connected the dots between Beijing's central bank decisions and your own financial pressure, share this with one person who needs to understand what's actually happening beneath the surface of official statements. The next video goes somewhere even this one didn't reach. It's about the mechanism China is building to replace SWIFT, the hidden infrastructure that makes dollar-free trade actually possible, and why the U.S. has no good options to stop it. Subscribe so you're there when it lands.